Hey guys, it's another episode of Ask J&A with Nick and Keith. Come to you today with another question from one of our clients.
Aren't market corrections inevitable, and how should I prepare for them?
Are market corrections inevitable?
Take the first part of that.
I would love to.
I want to know that.
You do want to know. I'm sure you want to talk about how they should prepare. I like talking about technical. Market corrections are absolutely inevitable. For those who don't know, a market correction is really defined as any time from a market peak, a high of the market, dropping between 10% and 19.99%. So anything between 10 and 20% range that pulls back, that's labeled a correction. Market's been up and going for about 116 years. There's been a correction every single year for 116 years. So the market has pulled back at least 10% every year in a 116-year time period. So market corrections are absolutely inevitable. I think the bigger concern people have are really the bear markets, and that's when a market loses over 20%. So of those 116 events that happen, 80% of the time they just stay a correction. They stay in that 10 to 20% range, and they pull back. We saw it in January of last year. We saw that market pulled back and lost well over 10% in a few days, if you remember. I mean, one day we lost 900 points, and about $2.2 trillion went out of.
Sounds like a lot.
It's a big number with the T. So that happens, but 20% of the time they result in what's called a bear market. And that's when the market loses over 20%. Those will make us extremely nervous. While they're not as common, those are really catastrophic, especially when you're taking income. So like I said, they're absolutely inevitable. So what history shows us, we will see them. And the biggest part is how you prepare.
Sure. I'll tackle the second half of that is preparation. While Nick's coming to from the scientific standpoint, this data that it's really known. We can track the volatility. We can see how that plays out in a portfolio even before it happens to a good degree, just based on previous volatility being indicative of future volatility. But the other part that's inevitable as we work with clients is how they may or may not react to that activity. And there are certain things you can absolutely do in preparation, not just to manage your own emotions through a correction or a bear market, but make it your friend. If you look at what separates amateurs from the professionals is that professionals understand that these are statistical data points they can prepare for, and they organize their assets in such a way to do that. And that means having cash available to make purchases. Our lid strategy is an example. Our UDS that we've used in the past really prepares not to have all the cash deployed in such a way that it's participate in the market, but when we have a correction, or quite frankly, better yet, a long-term downturn, is the absolute opportunity to redeploy assets in such a way to find value. But it's counterintuitive to the amateur investment. You want to see that your accounts are performing in line with the S&P. We use those as indications of performance. Well, particularly now, the market's been up 8 years in a row. We haven't seen either, haven't seen a bear market. So, we certainly feel like a bear is inevitable. We know it's inevitable. We also know that corrections are inevitable. And if it's not inevitable, then ultimately financial work won't be of any value, which is not really anything that's occurred in the last 116 years. So preparing cash that you can deploy is a great way, a phenomenal way, having a strategy to be able to buy when those assets drop in value is a key to growing your overall wealth, and also to preparing emotionally for the psychological impact of these downturns. Either one of those, being fully invested in the market, as measured by the S&P or diversified asset base, really takes a strike against your investor psyche. Also, too, it leaves you exposed to really just having to ride this inevitable wave.
No opportunity. I mean, if you look at historically, the investors who've had the most success are ones first who have it set where they don't have to capitulate. I mean, they don't have to react to the market. And that comes in part of controlling that risk. So we use tools like Riskalyze, which helps us pinpoint the risk to help us narrow that down. But having that cash, if you look at Warren Buffett's in the world, Ray Dalio's in the world, those fellows, how they've made their billions is through being opportunistic in those times. The only way you can be opportunistic is to be prepared to have adequate cash, because when you're fully invested and the market pulls back, you are along for the ride.
Right, you very much are, and I'd rather have our clients in the driver's seat than being along for the ride. And that really means cash. And what that really means is, quite frankly, in long, sustained bull markets, is you're really not going to perform point to point with the markets. That's really not the goal. You need to have cash available to buy discounts, and you need to have the psychological wherewithal to be able to do that. And that can be challenging. There's no doubt. Your advisors that you choose, if you're coming to us from another market, for example, or from you currently need to be guiding your advisor to prepare yourself for cash so you can buy when the discounts happen.
Absolutely. So the answer is yes, absolutely inevitable. The biggest part of that question was the second part of the question, which makes like is the preparation, because the preparation is where the opportunity lies. So absolutely inevitable, tremendous opportunity in those times. So be prepared.
Yeah.
Okay. Well, we thank you guys for the question. You keep asking them, and we'll keep answering. Thank you.